Yeah, my name is Paul Huebner. I'm an assistant professor at the Stockholm School of Economics and affiliated with the Swedish House of Finance. My research is particularly in asset pricing. I study how institutions choose their portfolios and how this affects asset prices and the economy more generally. The study in question is joint work with Valentin Haddad and Erik Loualiche. So what we are interested in this paper is if some group of investors changes their investment strategy, how is this going to affect equilibrium asset prices? And the change we are looking at in particular is the rise of passive investing. Now you might think that financial markets are this fiercely competitive space. And what it would mean is that, well, if you see this local change, like some investors becoming passive, it really shouldn't matter. And if you dig deeper, what it means is that yes, there's going to be some capital that changes to passive, but at the same time, everyone else is going to look for opportunities and it doesn't matter. Think of it as somebody stops looking for $20 bills on the floor. Well, it doesn't matter because everyone else just looks a little bit harder. Now, what we do in the paper is we quantify really how strong is this feedback effect. We find it's about 2/3 of the direct effect. And if you plug that in with the rise of passive investing, we've seen over the past 20-25 years, what it means is that asset demand curves have become more inelastic by about 12%. Yeah, so let me maybe take a step back first and explain what inelastic means. So imagine the price of NVIDIA drops by 1% for some completely non-fundamental reason. Well, what the elasticity tells you is by how many percent am I going to increase my demand for NVIDIA as a result of that. And that's really important because if you think about some shock happening, somebody trying to sell, it tells you how willing other market participants are to step in. Now, it turns out passive investors are the ultimate inelastic investors. It's because no matter what price you offer them, they're never going to buy what you have to sell. It takes two to tango, and passive, they don't dance. So what it means is that whenever you have a shock and you have a lot of passive investors, the pool of investors who can possibly step in is smaller. So naturally, you're going to see less liquidity and more impact of these prices. Whenever that happens, that's going to translate into more variation in prices overall. That is more volatility. And also it's going to mean that on average prices are going to deviate more from fundamentals, so you're going to have less informative prices and less efficient markets in general. Yeah, there's really two mechanisms you can think about here. One is really more about the retail investors and what they do. And the other one is then going to be related more to institutional investors, and that's ultimately going to be more what our paper is about. So the first one is basically what you could imagine is that whenever a shock happens, retail investors could amplify it by taking money out of their funds. That's actually could be both taking it out of active funds or passive funds. And that can amplify things. So that's not so much what we talk about in our paper. Instead, what we're talking about is fix the size of the shock, fix the amount of people who want to sell, it's going to impact prices more. And that comes back to this idea from before that the passive investors, they're not going to be on the sideline able to step in and trade with whoever wants to sell. And naturally, that's just going to translate into prices having to move more just because there's fewer market participants who can absorb a shock, and therefore they'll require that prices move more to incentivize them to do bigger trades. Yeah, so I think there's two good examples in 2021. It's not the most recent one, but I think it's still good examples. So one is GameStop, the other one is the failure of Archegos. So in the case of GameStop, you have a bunch of retail investors coming in trying to buy one asset. Well, somebody has to sell to the investors who want to buy. And it's not going to be the passive funds. They're not going to sell. So that's, again, going to amplify the price effects of this. On the flip side, think about Archegos. Archegos was a family office slash hedge fund which got into trouble and they had to sell. They had some massively concentrated position in a few stocks where they were very levered. So basically, what happened is when they had to sell, it was difficult for other market participants to step in, just because they had such concentrated positions in these few assets. And of course, the presence of passive investors who again don't step in make this even harder. So again, you're going to see that prices move more, presumably, than they would have otherwise. Now, of course, in neither of these two examples, passive investors were the shock. It just means that in the presence of passive investors, the pool of investors you can trade with are smaller, so that means prices will change more in response to the shock. So the very caricatural example here is take it all the way to the extreme. You have 99% passive investors, and there's just this last active investor standing. Do you really think that this investor is able to still make markets perfectly efficient? Well, might be very difficult for them. Now, ultimately, we try to convince people with data. So what we do in the paper is, again, we go and we measure how investors actively trade. And then the answer, which is 2/3 of any sort of direct effects, are compensated for. That's not us saying this, that's the data speaking. Yeah, so this comes again back to the things I've talked about before with less liquidity and more volatility. So that's one thing. Now you could argue, well, maybe for a long-term investor in particular, these things might not matter quite as much. But there are other channels through which this could play a role. For example, we know that large cap institutions disproportionately benefit from passive inflows. And what that means is potentially it's going to drive this deviation in valuation levels between large caps and small caps assets. Now, this happens admittedly for many different reasons, but this might be just one more aspect amplifying this effect. And what it means is that you're going to have more concentrated indices. That means less diversification and again, potentially more volatility. If you believe that this is going to drive up valuation levels, especially for these large cap assets, what it means is that expected stock returns going forward are going to be lower. And that's, of course, going to be very concerning for investors. Yeah, that's a very interesting question. So we see this in a couple of places. One of the biggest ones is what we call the index effect. So there the idea is that, let's say Tesla gets included into the S&P 500 index. Well, what it means is that on the reconstitution day, the day that the index changes, a bunch of passive indexers are going to buy Tesla and make it part of their portfolio. And because of this price pressure coming from this, the price of Tesla is going to increase that day. That's what we have 40 years of data suggesting that that's what happens. Now, of course, active investors are very smart and they started to figure this out. So what they started to do is employ a bunch of people whose job it is basically to predict which stocks are going to make it into the index or not. So they started front-running these kinds of passive trades. And therefore, it's not surprising that today we see that the index effect is potentially not even there or weaker. That's because all of this has moved earlier through active funds front running. Another example of this is other types of institutions, think about pension funds or so, they're rebalancing their portfolios, often in terms of rules or through rules that are predictable. And again, you're seeing a similar pattern of active institutions or active certain types of active investors able to front run this and profiting from this beforehand. let's not forget there's like this big positive impact from passive investing, which is giving retail investors the opportunity to be invested into the market for cheap. Now, of course, as we've just talked about at length, it does come with some negative externalities. So if you take the perspective on the regulator, you really want to trade off these benefits with these costs in what we economists would call welfare analysis. Now, this is really difficult to do, but one thing that probably is not going to be the result of this is the regulator coming in and saying, hey, let's outlaw passive investing. Instead, what we think might be a good way to go, or at least I think is a good way to go, is think about what are the forces, the frictions that stop the market from being ruthlessly competitive. Because coming back to our paper, whenever you have this perfectly competitive market, then you're not going to see these kind of negative consequences. So the question becomes, how can the regulator strengthen how competitive the market is? And for example, one way to go is by improving the information environment, how easy it is to acquire information for active type of investors. Yeah, so that's a very fascinating counterpoint. Like we see this opposite trend of the rise of artificial intelligence in particular, more generally the ability to process a lot of data. And that's presumably going to make the job much easier from the perspective of the active investors to be able to find these opportunities and come in and make the market efficient. Now that said, so far in our sample, we haven't seen this as much. And in particular, our sample ends around 2020, so we might just be missing this period. However, over the time period, in particular post-financial crisis, we've actually seen that quite the opposite, which is institutional investors becoming less active institutional investors becoming less active themselves, and looking somewhat closer to what we would call closet indexers. That's what you expect if an active fund would have some benchmarking proportion of what they do. Now, going forward, of course, like these big trends, artificial intelligence, etc., might turn this around. But what we can probably say with pretty high degree of certainty is that the passive flows, at least in the short and in the medium run, are likely going to continue.